Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is March 11th of 2024. I am recording from the road this week, so apologies ahead of time for any tech mix-ups. But let's go ahead and get started on the presentation. So this week's presentation is called Embracing New Highs. And the reason why we really want to emphasize that title is we're going into a bit of a tricky market where the market itself remains healthy. When we look at the stock market outside of the big seven names, the Magnificent Seven, technology, areas where we believe there is froth, where valuations are definitely in bubble territory, the average stock looks pretty good, but things can the the top of the market, technology and the Magnificent Seven in particular, distort the S&P 500. So we want to separate the problem area valuation wise versus the rest of the market. And so first thing we want to do is kind of talk about bull markets. Now, bull market is generally defined as a market that has regained its prior high before a bear market started, right? So the last time the S&P had a record high was right there near the end of 2021. And it took just over, what was it called? Let's see, 511 days to regain the prior high, which we did in the last couple of weeks. So you hear the markets going up quite a bit, and it hits a record high, and you're like, oh my God, like just a matter of time before the market crashes again. Let's take a step back and remember that the first time that a market hits a new high, that's the start of a bull market. So we did here is say, well, what were the 1-year forward returns throughout history after reaching the first record high after a bear market? And you can see here, it's very attractive. So if we look across the board here, we're talking about double-digit forward returns on average. Really, the only anomalies were in 2007, which of course we had the 2008 crisis a year later, and then of course in 1967. So really just a couple of anomalies in that data set, but generally speaking, the 1-year forward returns are historically positive. And then historically, strong returns before the next bear market arrives are kind of that rule of thumb. So let's not battle strength. Let's not fight the strength of the market and worry about, how the market could crash, right? So the thing that we are worried on is, of course, the crowding that's taking place in technology. AI can do no wrong, of course. And I would note that at the beginning of the year, everyone and their grandmothers were bullish on the Magnificent Seven. Well, that has slowly started to crack. Those minor cracks that we talked about for months now in the Magnificent Seven have widened into some major chasms. So Apple has completely broken down. Google, Tesla have completely broken down. We really only have 4 of the 7 that remain intact. And there's actually some early cracks taking place in Microsoft and Amazon. So we want to watch that because the consumer space continues to weaken. Microsoft looks tired a little bit. The absolute chart looks fine. The relative strength chart, a little iffy. But again, NVIDIA and Meta really are increasingly trying to hold up the space. So let's take a look at the Apple chart really quick. So what we say here is that core continues to rot, and that's for a reason, right? So we have a little 14.5% correction that's been taking place in Apple since it reached its near-term high, just under $200 a share. And this was back in mid-December or so. Well, we've been pointing out for a while, of course, that Apple has not really hit a new high for a long time. So if you owned Apple stock, you generally have not made money since 2021. And that's saying something when you think of the rest of the Magnificent Seven and what those stocks have done. And the first sign that we saw, of course, that Apple was about to go down was this breakdown in Apple versus the S&P 500, what we call relative strength. You can see here it really started to deteriorate months ago. and has completely broken down. The absolute stock chart has done the same. As you can see here, a classic double top technical from a technical perspective, which followed that breakdown in the relative strength chart. And you can see that here, about 14.5% correction so far. We think there's more downside to this. Again, we could be wrong, but we do think that there's significant downside ahead for the stock. The stock remains expensive. There's no real growth to speak of. You're talking anywhere from 0 to 2% revenue growth and no real AI exposure. And I think the announcement that they're pulling back from the Apple Car project really sort of speaks to that they're scrambling to catch up in AI. Google, no different. Well, 13.6% drawdown from its what I believe is that record high there in mid-December. And again, you see that here, the relative strength chart deteriorated months ago, gave us that first yellow light with Google, one of the reasons why we don't own it. Now, it is the one name that valuation-wise is not crazy expensive. Still decent revenue growth, but they have a deteriorating search experience as it relates to their core product, which is Google Search. You go on to Google Search, half the page is filled with ads. And what you've actually started to see is that Microsoft's AI-backed Pilot, it's called Microsoft Pilot, is starting to catch some steam. And so that combined with the awful AI rollout that we saw Google introduce a couple weeks ago has certainly acted as a headwind to the stock. And to really understand the Google business, don't pay attention to all those other projects that they do. It's all about their ad business. And so any threat to that ad business is going to be a headwind for the stock. So again, now we have two of the Magnificent Seven that are in clear deterioration mode. So let's move on to Tesla. Tesla is the one stock that has deteriorated for a while. So since 2021, if you bought this stock in September of 2021, you're down 56%, right? So the stock is clearly in a long-term downtrend. And I would be remiss to say, but perhaps Tesla is just a car company, right? And those valuations are going back to where their auto peers are. And the other thing we'll say is that the EV market in general is starting to retrench. We've seen it across the board, whether it's with the Ford Lightning, whether it's with a lot of the other startup peers such as Lucid or Rivian. The EV market is just a little saturated right now. We're not particularly positive on the EV market. And so there's a lot of reasons for that. That's not the point of today's presentation, but it's to point to the weakness of a third peer of that Magnificent Seven, which is Tesla. Again, a very crowded stock for a very long time. The valuations aren't as extreme as they were back in here, but clearly remain a headwind. And they're beginning to slow down in terms of their growth rate, and you're seeing that with the price cuts. One last stock that I'll point out, not part of the Magnificent Seven, but certainly in that what we would call the top 15 category, which is Adobe. Adobe is somewhat considered that software AI king, one of the first companies to implement AI technology in their software, also showing some major cracks. Now, at the time of this recording, MongoDB, which is a stock that we've owned in the past. We love the company, love the management team. That's also starting to break apart as well. Relatively weak guidance from the report last night. Truthfully, the earnings report for MongoDB wasn't that bad. It was really, at the end of the day, it's the wrong stock at the wrong time, just as we believe we're at the tail end of this AI bubble. So as you can see here, again, lower highs and then a breakdown lower here for Adobe. These are major technical cracks. The relative strength chart has begun to crack as well. Again, something to watch for the wider software space. So that would be like your ServiceNows, your MongoDBs, etc. So Workday. So these are the things that we want to watch going forward. So we think this is part of a broad leadership rotation where money is starting to look for value and finding and and paying for those investments by cashing out on their growth stocks. So, what are the areas that we like? Energy remains one of the cheapest sectors in the entire market across the globe, single digit PEs, very high free cash flow growth. And we think really at the beginning of a multi year bull trend, banks, cheap, good net interest margins, a beneficiary of today's interest rates. And of course, year over year, with some of the crisis that we saw with the regional sector a year ago, which has largely, in our opinion, been taken care of. And we'll show you why here in a bit. Orphan growth sectors such as cannabis, materials, chemicals, and of course, emerging markets. So let's take a look. Tech or boring banks, right? So on the tech side, what we've seen is on Wednesday, the percentage of technology stocks with a negative two standard deviation decline, well, 25%. That is what we call a negative volatility alert. On the flip side, we had the banks with a positive 2 standard deviation alert. And I think what's interesting is if you go back to these charts over here, this is clearly a sign where leadership in tech is breaking down, right? We look across these charts and you see that the leadership is finally starting to break down. NVIDIA has been kind of clouding that, masking that weakness. AMD, other semiconductors have been masking that weakness. But underneath the surface, what you're seeing is this rotation out of tech and into boring sectors like the banks, which are very, very cheap. So when we think of energy, which is one of our favorite sectors, our largest overweight in our growth portfolios, what is it? It's pretty simple, ladies and gentlemen. Global oil demand is rising. There's no doubt about that. So a lot of these headlines out there that talk about demand falling, that's just simply not the case. Supply constraints remain a key bottleneck for the energy industry, just quite frankly, a lack of long-term capital investment into the ground. We're seeing that in the shale space right now, where the efficiencies of those wells are declining. So you need more dollars to get the same amount of production or more production than you did a few years ago. That's the first sign that you're starting to reach peak production. And then lastly, that shale consolidation and higher dividends and buybacks. We've seen that with names like Diamondback, and then with Oxy and other names in the space that have continued to consolidate assets in the Permian Basin. The Permian Basin is the mother's milk of U.S. global oil production. That's what we want to pay attention to. Most of our energy assets are concentrated in the Permian Basin or in Canada. So BC and Alberta, looking at those equivalent, what we call the oil sands production plays, which have very, very low production, very, very low break-even rates on their production. So we're focused on names that can still raise production, take advantage of higher oil prices in an environment where demand is rising and production is starting to fall. In China, we've talked about our bull thesis really being a contrarian play where the underlying companies are not doing that bad, but being offered at single digit PEs. So in other words, if you could buy Facebook at 8 times earnings, would you do it, right? And we think of one of our regrets was not buying Facebook at 8 or really 10 or 11 times earnings back in 2022. Let's look at the Chinese 10-year yield. Really climactic here, people chasing and paying for safety at any price. We think we're near a flush in the bond market in China as well. We saw JD report earnings this week. Stock was up 17% on those numbers. Again, the first sign that a lot of these stocks are reading through some of the poor data that has been pervasive in China over the past few months. Contrary to that, of course, is this week's report that exports actually surged about 7% in China. So again, a lot of pessimism, but so definitely some green shoots taking place there. Regional banks, again, the risk spreads on the bonds have remained contained despite some very negative headlines as it relates to banks like SBNY, et cetera. But underneath the surface, these banks are breaking out, right? So regional banks showing signs of breaking out, backed by declining risk spreads on their bonds. And again, these are banks that are very cheap, in many cases, single-digit PEs, solid earnings growth backed by high net interest margins. So in summary, ladies and gentlemen, We really do think that investors should embrace new highs. Don't panic because the market's doing well. Bull markets do spend most of their time overbought. Important to remember. Where can you play defense? We think within tech. We think tech is an area where people are exposed to bubble valuations. So we think the play here is to rotate away from the top of the market toward the average stock in the market. We see strength broadening out across energy and banks and increasingly across the value space within the S&P 500. So that's what we got for you this week, 888-543-3776. Again, thank you for your business. Thank you for your time. If you have any questions, please feel free to reach out to your advisor and have a fantastic week. Thank you.